Right. Hello, everyone, to this next GS panel. Today we're going to be talking about the 2020 budget. And with me today, I've got, thankfully, Rebecca Thomas, Director of Mint Asset Management. And we're lucky enough to have her as our own independent director on the GS board as well. And of course, my fellow director, Bruce Sheppard, who most of you have probably heard about in one way or another at times. So thank you both for giving up your time, come along and provide your thoughts on the 2020 budget. So with that, obviously what we've seen is the government's COVID-19 response package has a price tag of circa $62 billion. Yet noticeably missing from the budget was any commentary around how they're actually going to fund this budget, particularly any sort of potential use of tax measures like raising the income tax rate or the GST rate, which a number of people out there have suggested was what was going to happen. So I'm just interested in your respective perspectives on this, perhaps why it was or is not there, and on the likely prospect of such measures being introduced in the short term. So perhaps, Rebecca, if you'd like to start off with your thoughts.
Okay, thank you, Richard. Look, I think the reason they haven't done it is because it would be political suicide to do it now at the time when they are handing out the lollies to everybody and giving money away. I think they also recognise from an economic point of view that their revenues are naturally going to be going down at this particular point in time, and an awful lot of businesses are going to be doing it very, very tough. But you know, they'll also be sensitive about the comments that they made after the tax working group and the potential introduction of capital gains tax, which obviously put the frighteners on a number of us and a number of savers in particular.
Yes.
So I think that they will definitely have to move in terms of taxes. I mean, if the deficit does peak at the 200 billion level that people are talking about, which is 50-something% of GDP, and if it's not going to be a massive intergenerational transfer, then they're going to have to start to actually work their way to pay some of this back through increased taxes over time. So yes, I think GST increase to 17.5 or 20 is a sitter, and broadening the net potentially of GST. Certainly in my area, financial services, which has had at least a partial exemption for some time, maybe go to full GST. And I do think that it is inevitable, but it's them getting that timing right relative to the election. So that's my short answer.
Yes, thank you, Rebecca. Bruce, how would you comment on that?
They were clear on how they were funding it. They're issuing government bonds and the Reserve Bank is buying them, right? So in short, we are funding the $62 billion by printing money in one form or another. It shouldn't be inflationary because the deflationary pressures are now enormous, undescribably enormous. So I think it's clear how they're funding it. I agree with Rebecca, increasing taxes before an election is crazy. Actually spraying money indiscriminately at every single voter is politically very smart, but economically very stupid. The $62 billion has relatively little detail around how it's being targeted. Certainly extending the wage subsidy for businesses with 50% less revenue is, on the face of it, a sensible idea, but it will save what I call zombie companies as well as good companies that need to survive. And the problem with saving zombie companies is they remain as market spoilers, which effectively stifle the midterm recovery. So I think strategically they're making a poor decision. Politically, they're making a smart decision. And if they get a mandate at the next election, you can bet your bottom dollar tax rates will increase. I think I've already said, I believe that we will have the prospect of a state duty reintroduced.
Yep.
Because they are concerned about wealth concentration. Not that a state duty ever dealt with it, but it's a good flagship policy. I think we will have GST moved to 20%, A, because I think they can get away with it, and B, because the arithmetic's easy. And I think we will see tax rates at a top marginal level of 45 to 50%, probably at bands as low as 100 or 120K. All perfectly conceivable, but none of it will make a dent in $200 billion of debt inside 30 years, because you've got the demographic wave of increasing health budgets, which we conveniently avoided mitigating by letting them die of coronavirus.
Right. Some interesting comments from both of you. And as an aside, I guess I should have mentioned there, of course, 20 billion of that amount, 62 is presently in a so-called kitty, so I guess it's not targeted as yet.
They've established it. They've established a lolly fund, a bit like the regional development fund of the last budget for Shane Jones to go out and buy Northland so he could get re-elected and not have to worry about the party vote. It's all complete pork bellying.
Yeah.
Right. Well, Grant Robertson made the comment, you know, this budget is about jobs. So I'd like to hear your respective thoughts on whether you think budget 2020 is actually will provide the platform for achieving that desired outcome or not. And perhaps start with you first, Bruce, this time.
Look, jobs are created by entrepreneurs who run real businesses and innovate. That's where valuable jobs come from that give people not only income, but satisfaction and pride and purpose. Jobs for jobs' sake is just welfare and make work programs. You know, he's talked about spending money on building roads, for example. That will create jobs, not dissimilar to bulldozer Bob Semple in 1935 getting out with chains of unemployed people with picks and shovels and wheelbarrows. That created jobs too. Yes, we still have those roads. You know, we enjoy walking on the waterfront road. My grandfather, with a wheelbarrow, poured rocks into Hobson Bay to make the waterfront road because he was unemployed. Is that what we really want? No, we want businesses to create jobs. How do businesses survive? They survive by having cash flow. Cash flow starts with consumers and savers. Savers invest, which gives businesses the capital to deploy, and consumers buy things that enable us to actually have cash flow to produce a profit and employ people. The only plus of this budget is they are doing everything they can to pump cash into the economy through borrowing and subsidising employers in one form or another, the good, the bad and the ugly, spending money on stupid projects that may or may not make sense with piss poor economic rationale behind most of them. And in addition, effectively saying to welfare beneficiaries, here's another $75 a week permanently for you to spend on keeping the economy running. It won't. It'll go on the usual things beneficiaries spend money on. So untargeted pump priming won't particularly correlate to jobs, but it's probably better than doing nothing, and the shrinkage is probably greater than it could have been, but it is what it is.
Right. Rebecca, how would you respond to that?
So look, my thoughts are that, look, I totally agree with, as I said at the beginning, I don't think governments are very good at creating jobs. I think it's business people and businesses that create the jobs, and that does need cash flow, and it does need the resumption of normal consumption and buying patterns, and we haven't got there yet. So I would call it a job preservation scheme rather than anything else. It's keeping the show on the road while everybody figures out what the new normal actually looks like in the long run. So I'm incredibly skeptical of the training and apprenticeship scheme, transfer of labour from Queenstown to other parts of the country. I mean, we don't have a particularly mobile workforce. Within New Zealand, people tend to stay in their regions. They don't move around an awful lot for jobs. So expecting people to shift from one part of the country to another, I think, is pretty unrealistic. And then there's some pretty small beer, in the context of this budget, in the hundreds of millions and tens of millions around R&D, money for exporters, money for small businesses, etc. I haven't looked at detail yet in what's precisely involved in those schemes. But I really don't think they're going to make an awful lot of difference. But my main skepticism is around spend on infrastructure, because this government's been was carrying a surplus from the previous government, and was ready to do an awful lot of infrastructure spend, and we have been unable to execute on infrastructure spend so far. So I'm very skeptical that we can do it now. Kiwi Build was a debacle in my view, because this government did not want the private sector to make a reasonable return on capital from being involved in that project, and so it's stalled and didn't get off the ground. So what we're now going to do with rail and what we're going to do with these shovel-ready infrastructure projects, I don't have a lot of confidence in. But the fiscal response is the right response now. We've done as much as we can do on interest rates. They're probably going to negative rates. We've got QE going on, and so we've got an awful lot of a monetary boost. But I'm very skeptical about the government's ability to actually create proper jobs.
All right. Okay. All right. Just to finish off, so budget 2020 included a few key initiatives for business. One is, of course, the extension we already mentioned to the wage subsidy to the 1st of November, another 8-week period. Although with as I think you both mentioned, the 50% revenue decline requirement as opposed to the present 30. 150 million of R&D loans, basically just to incentivise those already with R&D programs to continue. And also 216 million to NZTE to assist exporters, and 10 million in small business to basically improve or expand their e-commerce capabilities. Just from you both, who do you think's been left out in the cold in this budget, or perhaps what other areas would you have sort of, if you were, I guess, in charge, where would you have funneled the cash from this year's budget? So Rebecca, start with you.
Well, look, just briefly, and I think this was covered actually in the Herald, but to me, the missing bit, when I look at who are our key industries and I look at the components of New Zealand GDP and where growth has come from, obviously tourism has been a big engine for growth. Agri is obviously a major part of the economy, but overseas students is the missing bit of the jigsaw for me. Mint, with my Mint hat on, we manage money for a number of university endowments, New Zealand. And I've also got a son about to go to university in Sydney. And they are incredibly keen to open up the borders to get foreign students back into universities to start paying the bills. And I am concerned that other countries will steal a march on New Zealand if we do not get our act together pretty soon and open up those borders, because they are a pretty big revenue generator. So when I looked at the top level of industries, that was the one that I thought was missing something in terms of actually helping them start to get that revenue flowing. And these are not super wealthy organizations. They need that revenue stream from foreign students, and we've got a great reputation with foreign students. So that was my commentary on on that. I mean, in terms of what else I would have done, you know, it is extremely difficult in terms of where you target. Do you target at employers? Do you target at individuals? And yes, it's great to put money in the pockets of individuals, but by and large, they'll probably, as the Australians did with their budget giveaway, you know, go on holiday to Bali with them. Or whatever the equivalent for a New Zealander is, maybe go on holiday to the Gold Coast. But so it is difficult, but that dual approach of money in the pockets of people who are actually working as well as their employers, I might have tweaked that relationship a bit differently.
Right. Thank you. Bruce?
Look, my main sector would be the tourism and hospitality sector, and everything that supports the vibrancy of New Zealand as a destination of choice. Funding attractions and events to hibernate to come out of the other end would have made sense, because a fair chunk of that infrastructure runs the potential to be lost. Fair chunk of it requires reasonably significant capital expenditure, so you can't rely on organic regeneration. There was a compelling case, I think, to do something for the capital-intensive tourism sector rather than the labour-intensive tourism sector, which they can die and then be rebirthed, tragic though it may be. So I think the tourism sector was probably underdealt with. There is going to be significant shock waves through the construction sector. Many projects are going to stall. That will have the ripple effect through the top end and middle end of the building sector. I doubt, we were talking about, Rebecca, you were talking about their inability to execute on housing, for example, as one example of how they couldn't create infrastructure projects. It's going to become incredibly hard for anyone who builds vertically rather than horizontally to survive. And I think that the re-provisioning and support of that sector needed more support than it's got. I think we will significantly lose construction capacity over the next 3 years.
Right. Well, thank you very much, both of you, for your comments. Anything to add as a final sort of closing remark?
This is a spray and pray budget.
Spray and pray.
So I call it kicking the can down the road budget, and hope that there'll be some light at the end of the tunnel, and they'll be able to reorient things, I think, at that particular point in time. But look, I have to commend the boldness of it in terms of the scale of it. But I am worried about the next generation inheriting an awful lot of debt to pay off.
Yes, yeah.
It always reminds me of a Bromhead cartoon of Robert Muldoon, which was pre your time, but I'm sure you've studied enough New Zealand history to remember the boldness of Muldoon's Think Big projects, which were not dissimilar to this in terms of the vision for growth. And one of them was the Marsden Point refinery, which is being redefined by its private company now. And the refinery workers went on strike. And Muldoon pointed a revolver to his head and spun the barrel in the Bromhead cartoon. And one of his famous lines was, "Do you see the light at the end of the tunnel?"
Very good.
I just wonder if the light at the end of the tunnel, Rebecca, is the population and our future generation looking at their aging Jacindas in 20 years' time, with them holding a gun to their head and saying, "Do you see the light at the end of the tunnel?"
Yeah.
And if not, you did. We have mortgaged our children's future to save our parents. A very unbiological response from what are basically a herd of animals.
Yeah, but you know, the stock market's been doing that job for us for a while as well, right? With yield compression that we've seen in global markets. So it's a very, very tough time at the moment for savers as well. So where everybody's going to get their income from is another great question. But look,
so Rebecca, are you suggesting we save them from coronavirus so that we can starve them on the street as beggars?
Well, look, it depends what the banks do on TD rates, right? There's a whole another discussion on what happens if rates go negative, what that does to the psychology and the pricing of everything in terms of assets. But yeah, look, I think that everybody's universally feeling pretty poor at the moment. I don't think many people are feeling like their future's that rosy.
True enough.
Yeah.
Right. Well, thanks very much, both of you again, for your time. If anyone out there has any questions for us, I'd like the panelists to answer at any time. If you'd like to just send an email to Lisa at Gilshep, gilshep.co.nz. And see you next time. Thank you.
Thank you.
Thank you, Rebecca.
Thanks,
Back to
Brooke.
the millstone. I've got all